Welcome to the FinTalk Short Pros AI, where we spotlight the entrepreneurs and revolutionizing the financial services and technology transforming how businesses are done. For those joining us, we are Pros AI, and we specialize in helping fintech and insurtech businesses scale their revenue, reduce operational costs using various AI tools. And if you're looking to take your business to the next level, stick around. And if you want a free growth consultation, just drop us the word growth in the DMs and we'll get back to you. But more importantly, I'm really excited to introduce our guest today, Tim Holliday, Managing Partner of Space Station Investments, a firm that is revolutionizing how consumer brands access capital and strategic support. In just 6 years since joining in 2019, Tim has built one of the most prolific angel investment groups in America, growing from single magic spoon investment moment to over 107 companies, including 3 unicorns. Welcome to the show, Tim.
Yeah, I appreciate it. Really glad to be on with you today.
Tim, maybe just start by telling our audience who is Tim Holliday? What's the origin story of Space Station Investments? How did you get here?
Yeah, it's a kind of a winding path from born and raised in Arizona, and after graduating with a degree in engineering, never was an engineer. I built and bombed a couple companies trying to be an entrepreneur, and then ended up eventually building and selling a small tech company with my brother, who's now my partner. We sold that in 2016. And as I made the move up here to Utah, where the space station is founded, I was actually brought on to build out some tech here internally. That was kind of part of my goal and my job. Moved my 5 kids and my wife. I mean, it's kind of a big move. My kids were getting into high school and junior high, but we made the move here to Utah to join what is called the space station, kind of this really cool umbrella of and connection of our collection of companies. Right. And yeah, we got into investing in kind of an interesting way, which I'm happy to share. But the overall space station is interesting because it was founded and is founded by a creator, an influencer. He's actually the top guy on Snapchat. His name is Sean McBride. He goes by Sean Duras. Moved from Snapchat to YouTube, built out some YouTube channels, and we decided early on to keep building in the creator economy. And so we have an influencer marketing agency, animation studio, esports org, and then I get to run now the investment group.
That's amazing. And you've built some really amazing ecosystem around, because Space Station is not just about investment, it's about surrounding the businesses that you bring on board with a very good ecosystem. Can you walk us through how that actually works? How does that ecosystem activate?
Yeah, so as our first investment in 2019 was in a company called Magic Spoon, high protein cereal. And we actually were not intending to build this portfolio of over 100 companies. We're actually at 128 now, even since the bio that you read, we've been moving. But the intention was simply, we wrote a check and invested in this company, knowing that we could help them grow because A, we know how to build audience. Internally, we have 2 YouTube channels that do hundreds of millions of views a month. And also B, we have this influencer marketing agency internally, which is even older than our investment group. It's 8 years old. We've worked with hundreds of creators, dozens of brands, and we know how to activate creators with these brands on YouTube, Instagram, TikTok. So we cut this check into Magic Spoon. We really just put our heads down trying to be great strategic investors. I was tasked with the job of seeding out or pushing out a bunch of Magic Spoon to these creators and pro athletes. And it was kind of funny. So Magic Spoon is known for a bowl and spoon that you can either buy or that they'll send to their subscribers. I accidentally invented that bowl and spoon. When I was seeding out a bunch of product, actually I have it right here on my desk. I was seeding out all the product. I'm like, you know what? We need to send out more than just these boxes of cereal. So I literally ordered this dog bowl on Amazon, and this is the original #1 Magic Spoon, and ordered it, sent them out to a bunch of people, and the founders started to see on Instagram and YouTube these videos popping up with this bowl and spoon. They called me up and said, "Hey, that's really cool. Can we steal that idea?" And of course we said yes, and they built it out. So that really playbook of us kind of activating our creators and influencers to help these brands grow is really the key to our value add as investors. We invest in early stage consumer companies. We try to bring interesting creators, pro athletes, Olympians onto the cap table as investors. So they literally invest cash like everyone else. And then once they're in the company, then we activate with our influencer agency and help grow the companies.
That's an amazing ecosystem for sure. I mean, it gives these companies a really big leg up. I mean,
Yeah, that's the idea.
yeah,
Yep.
and your ecosystem is obviously very remarkable. You also have gaming for
Yeah.
esports, space
Yeah.
station. How does that work? Can you walk us through that a bit? How does that actually change things for these companies?
Yeah, it's been interesting. I mean, even on the esports sides, we have Space Station Gaming is one of the top esports orgs in games like Halo, Rainbow Six, Rocket League. We have some of the top teams in the world. And we've had a couple cases where that kind of connection has been really helpful to our portfolio. You may be able to hear, some of your listeners can maybe hear in the background, there's some yelling and noise going on. We're actually filming right now for our esports group is filming an activation for Oats Overnight, which is one of our portfolio companies who sponsors the esports. So
Right,
Oats Overnight, one of our early portcos, is the major sponsor for our esports org, and they provide value back and forth. And we've seen that play out a number of times. We also have had our animation studio, which animates our A for Adley channel, which is a really great kind of kids focused, family focused channel. We'll do
right,
animations, and we have integrated our portfolio companies into the animations as well. And so
right.
there's a lot of like little touch points inside of the space station, led by the influencer marketing capabilities that we have internally.
Right. I mean, but Tim, this is not typical VC investment style. This is what gave you
Yeah,
guys less of, insight into we could do things differently because this is
yeah.
really amazing what you do. But I'm just struggling to see, and maybe our audience will also be thinking, how did you think about this?
It's so funny. It's like, I wish I could claim that this was a master plan thought out in great detail, but honestly, it was one check into one company, Magic Spoon. And
Right,
maybe had that not been our first investment, maybe I wouldn't be here today. Maybe had it not grown so well during COVID, but it did. It was one of the fastest growing direct to
right.
consumer companies of all time. So I wish I had could claim the credit. In reality, this is our investment group itself has been very much a bit of a startup, almost like a kind of a fintech startup in a way, right? Like we literally are an investment group
Right,
startup
right,
where we realized once we had that engagement with Magic Spoon that we had some unique value to add from a venture perspective. A lot of other VCs try to add value in different ways, and that's great. And some really do, some don't as much, and some are worse than aren't helping at all. But
right.
our very specific value add for consumer companies just happens to resonate well, and we
Yeah,
just lean into that. That's really been kind of the key to our success is leaning into the value add and then really also running this as a very kind of hopefully a world-class venture
right.
group. And that's been the combination that's worked.
That's amazing. Let's talk about the Space Station Club, your
Yeah.
syndicate. I read that the CEO of Aura Ring said publicly that your syndicate brought over 100 million followers to their 100 million round. That reach will be material for their next phase. Can you talk us through that? How does you structure this syndicate? Are all the influencers and athletes actually co-investing with Check, or is it more of a
Yeah.
strategic partnership?
No, in fact, right now we don't do any what you're calling a strategic partnership, which is, these creators, athletes gaining equity for services, for influence. We've chosen not to do that approach. Those deals are, hard to craft, hard to
Right,
really the attribution. So when we present an opportunity to the Space Station Club, which is our private group of investors, which include investors like you and I and others who've kind of been successful in business in different ways, but also
right,
includes a lot of these creators and athletes. They invest like anyone else. They put actual cash in like anyone
right,
else. We close the deal, sign, wire, done. and then we engage those investors. And often it's not immediately. I mean, there's times when it's been 6 months later that we're engaging, a year later that we're engaging. So we try to structure those deals in such a way that the investors are glad to be an Aura Ring no matter what. They're happy to be an Aura Ring as an investor. Then if we can also add some additional value, then that's the bonus. And honestly, in the case of Aura Ring, yeah, bringing 100 million subscribers amongst all of our creators and athletes that invested is a real unique stat for a venture group, right? Like you don't typically track the influence that you're bringing to a deal, and that's what we like to do.
Right, right. And I look at your portfolio. I know you've really ventured out of 120
Yeah,
plus
yeah,
companies now. But it's not like sector specific. You're in consumer, you're in health
yeah,
tech,
yeah,
you have Web3 with Kraken.
yeah. That's right.
How do you balance this? How do you ensure the like how do you evaluate expertise across all these categories, and how do you ensure quality value when you add each sector, because each sector is
Yeah.
quite different, right?
Yeah, they're very different. I mean, we consider ourselves a consumer investor in that consumer we define very broadly. So about a third of it is CPG, that's your Magic Spoon, Olipop. A third is fintech, health tech. We've done fertility tech, and then a third is what we call consumer adjacent. So that can be a B2B SaaS company that adds value to e-commerce, or it's like a B2B to C place. That's the broad spectrum of our portfolio, and you're right to identify that it's diverse enough that it's challenging to have a very defined playbook to
Right.
add our value. And so we don't have a defined playbook. Honestly, like we don't have some like invest in this company and this is what we do and this is the outcome. In reality, we are getting access to just really top great consumer companies. Deals that we invested in are a great company called Garden Cup, which is a green salad delivery to your door. That have really nailed down supply chain and have just an incredible product. And then Beast Industries, which is Mr. Beast's kind of whole world, which is a very high profile consumer play. And in all cases where and then yeah, to your point, Kraken. I mean, how do you analyze and assess Kraken or Strike, or we have a fintech called Crew, which is like a family kind of online banking and card system. For us, it's three things. Number one, founding team founders. Like at these early stages, it is critical that we just have high conviction that the founding team is the right team. Number
Right.
two is the product itself has to be something that we are excited about, proud of, and where we know we can add value. So
Right.
therefore, we as a group, we don't invest in what we call like addictive categories, gambling, alcohol, CBD stuff. And then we also, the third would be just the progress. That's where you get into more of the science of the
Right.
deal, where are they at? How capital efficient have they been? What's their capital needs? Are we adding fuel to the fire? And then how can we apply our value add? So it's a relatively standard, I think, kind of analysis from a venture perspective. Like we're looking at it like most VCs would, but I do think that we have this slightly unique lens through
Yeah.
which we can look at a deal where we know that we can add value. And by the way, part of what we try to do is not only broadly, try to activate influencers and creators. We actually will go and target certain creators and influencers to join the deal. It's like somebody who's really endemic to golf and we have a golf deal. It's like we're going to try to find, bring those people into the deal and work that way. And that's an example of how we try to work
That's
broadly with this pretty diverse
yeah.
portfolio.
No, that's quite strategic and quite unique also, because you've been able to grow, and I look at this, and from that one company to over 100 companies in
Yeah.
4 years. That's a staggering number per year. Incredible
So,
pace. How do you source deals at this velocity? Is it inbound? What's your go-to-market strategy? How do you get them?
yeah, that's a great question. I mean, we in the early days, literally, we're hunting down these deals. Magic Spoon came to us through our partner, and then Olipop was a cold DM on LinkedIn. Incredible that David Lester, the founder, answered, and it was because we had invested in Magic Spoon, and they knew Magic Spoon well, knew the founders well.
Right.
Oats Overnight, same thing, cold outreach. So we've been successful in being able to, because with this value add and some of the cachet of the space station and Sean
Right.
Duras and the founding story, like we're able to kind of generate interest. So, founders take our calls. That was in the early
Right.
days. Now there's such a flywheel movement that for example, we had sent across our desk over 1,200 companies in 2024. And it's like there's no way we're analyzing 1,200
Cool.
companies, right? So the inflow is really powerful. And nowadays it's a matter of, well, in every case, and I think most venture guys will say this, it's like, yeah, you might have a ton of deals come across your desk, but at the end of the day, it's having high quality deals that really are kind of some of the top in the industry come across your desk. And in that case, it is reputation, trusted
Mm.
network. Other founders will send us opportunities that they're seeing. But honestly, like it's important to note that like there was a time, in fact, I don't recall exactly the time frame, but
Mhm.
there was a 12-month period, so a
Right.
52-week period where we did about 52 deals. To give you perspective on like the trajectory of what we were doing, this is back in probably 2020, 2021. Obviously, a very
Right.
frothy time, but in that is some of our best portfolio companies, some of our unicorns. So what I'm saying is we put a ton of time and effort into really quickly learning this consumer space.
Right.
Now our pace is, I think last year we did like 16 deals. We're on track to do about that this year. So that's kind of
Right.
where we're settling,
Okay.
12 to 18 deals a year,
Yeah.
is where we're at now.
But now going really like for quality, you're looking
Yeah,
at
yeah.
that. But what is interesting that I picked there is, like cold outreach on LinkedIn gave you something of real good quality. So that actually happens.
Yeah, it can happen. And honestly, I wish I had some awesome, little something to say to help anybody
Yeah.
listening. Like, how can I do that too? I
Yeah.
don't know that there was much magic that we did. I mean, a lot of it is
Yeah.
just very intense, quiet grind of just
Right.
pushing and working. There's no secret there. I will say that because we have the unique value add, it made that cold outreach a little bit more powerful. But there's
Right.
one factor too that you have to always remember, which is timing and luck.
Mhm.
100% came into play. This
Right.
was COVID. We were all of a sudden locked into our rooms,
Mhm.
I literally in my basement talking to the founders of these companies, and they were a lot more open to taking video calls all of a sudden. Like all of a sudden now everyone's like, what do I do now? And we're all sitting at home. And so that was a time when we were able to engage in that moment to grab these cold outreaches. And then of course, Magic Spoon, one warm and eventually a very hot kind of portfolio company turned into two or three other introductions to portfolio companies internally. So there's like that, again, that flywheel that gets going, but it does take typically a crazy amount of effort, even
To
for anybody in the audience here, as they know, just crazy amount of effort. For example, we're fundraising right now, raising our first venture fund. So it's been all SPV work up until now. And
right.
even ourselves now out raising, just like our founders, we're out raising capital, trying to round up, our $40 million fund. It's a grind. There's not a lot of secret to it. It's just a grind.
You just walked straight into my next question because I was
Yeah.
going to ask, you are raising this 40 million
Yeah.
institutional fund. It's a massive milestone. Congratulations.
Yeah. Thank you.
But looking ahead, if you want to get like, you are now 100 and something companies,
Yeah.
120 plus, looking to get into 200 plus and institutionalize the platform further
Yeah.
the next 2 to 3 years, what would be your biggest bottleneck and how would you look to resolve that?
Yeah. It's a great question. I mean, there's probably a couple bottlenecks that most VCs deal with. In our case, of course, it's deal flow is probably one of the top. It's critical that we have access to the best deals and
Mhm.
that we're able to negotiate in and take a seat with these companies. We haven't yet had too much of a challenge doing that, meaning like we're not highly competitive against other VCs. We're looked at as very much value add. Like, yeah, bring on the space station, bring them in. We'd love to have them add on to the round. But now with a fund, we will have the ability for the first time to lead around, to co-lead around, to take a board seat. We'll have a little bit more ability to dive in and cut a larger check, and
Right.
that might get us into competitive state. So it's the bottleneck of analyzing deals. We are growing the team along with this fundraise, but even then we are a very lean team, surprisingly lean team, and that's how we want it to be. We're not trying to be Sequoia or A16Z. We're happy to be a very hopefully world-class boutique investment group that has a unique value add. And so that's a piece of the other piece, of course, is just the value add, right? I mean, with over 100 portfolio companies and more growing, it's important that we have the capacity to help, the capacity to really dive in and add the value. So far, so good, but I can see a world where we have to continue to build the other side of the house, our ability to add value. We need to build team around that to keep delivering there.
Amazing. I mean, it is a big milestone, I have to say, moving into that, stage where you can now lead rounds, take a bit more of the seat in the. But looking at the industry overall, the evolution in the consumer VC industry, 2021, 2023, we saw headlines, things were slowing down. But you're one of the few who kept investing aggressively through the entire period. Your seat as one of the most active consumer investors, what's actually happening currently in the consumer VC right now?
Yeah, I mean, 2021 was frothy for everyone in tech and in crypto. And some of that capital really sloshed around in consumers as well. We were able to grab some of our top portfolio companies in that era, fortunately. I think a lot of VCs got in trouble kind of paying high prices or high entry points as they invested in 2021. And so those vintages are not looking very good. But as we got into 22 and 23 and even 24, where things really slowed down, we found that we were able to really focus in, and that's where we went from 35 deals to 20 deals to 16 deals. We really focused ourselves into the highest quality consumer deals in those years and in those vintages, and we were able to find some incredible companies where we could find a better entry point. We're investing at now lower valuations, what we think are appropriate valuations, not the frothy 2021. So we were able to still have the conviction and the discipline to deploy capital, even when others were really holding back and sitting on their dry powder, kept deploying because we knew that there would be top consumer companies in that era as well, and that is proving to be true. And then now as we move into 2026, I think there's a lot of tailwinds that are pushing capital into all categories, and consumer is enjoying that. We're seeing some of our portfolio companies really maturing into kind of their own exits and their own transactions. We're seeing IPOs loosen up finally. That helps loosen up, and that will mean liquidity for investors, and that turns into more liquidity for new deals in 26 going forward. I also think that like consumer is an incredibly exciting place to invest. We definitely kind of have a bit of a, what would you call it, like a bad rap in the industry where it's like, yeah, I mean, consumer, that's cute, that's fun, but if you really want the real returns, you got to be in tech, you got to be in SaaS, you got to be in AI, right? And while no doubt there are some insane deals done in those categories where, 10,000x returns, right? You're early in Uber, you're early in Spotify, Shopify, of course you're going to be in. However, we find that in consumer, the play is less unicorn hunting, more in the baseball analogy, singles, doubles, triples. We find there's a very robust exit kind of capability in the $200 million to $800 million band, where these consumer companies can be swallowed up by these larger strategics. That's how they innovate. That's how General Mills, that's how Pepsi, that's how Coke, that's how they innovate, is they buy amazing companies in that range. That turns out to be an amazing return for our early investors and for the founders. So we see that only increasing in 26 going forward.
Yeah, and actually that's a very good perspective to bring in, because there is a lot of money being thrown into AI and all this, and what people forget is that for one Uber, one Airbnb, or there's lots and lots of other tech companies that failed, and what consumer startups have is longevity. They will hang around. They don't go as quickly as the tech.
That's exactly right.
Once a tech company fails, it fails. It's gone. But looking at the economics now, there's a major shift from growth at all cost to profitability, unit economics. What are you seeing, and what are are founders adapting to this, and what metrics are you prioritizing as we move into this phase?
Yeah, no doubt that we are seeing the same thing. Founders are kind of forcing themselves to be more disciplined in unit economics versus the growth at all costs. I think that's partly because of the last, call it, 48 months of just not frothiness. Kind of plays into that. When you have a market downturn, you often will see founders kind of tighten the belt, so to speak. We're
Right.
seeing that, and we're seeing that it's almost like yeah, there's a really exciting movement, cachet, exciting kind of, metrics around getting to profitability quicker, uh,
Right.
and making that the key kind of guiding metric that they're looking for. So therefore, you have to pay attention to your unit economics. One example is Garden Cup, which is again meal delivery. We're delivering green salads to your door. Many,
Mhm.
many have tried meal delivery. You'll see a startup pop up. They'll start delivering to the door, but they're not paying attention to the unit economics that it costs, $40 to get this $45 package to your door. And so
Right.
they're like, no, 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 grow at all cost, plow a bunch of capital into the top of funnel marketing, and then we'll figure out the unit economics. That's just
Right.
no longer how you can operate nowadays. You have to be paying attention to your margin from day one,
Right.
and that is
Mhm.
an important shift. We're finding that founders, as we as VCs are looking at and running diligence on these deals, we're
Right.
looking at unit economics. What is your margin today? And if it's not in a decent kind of band already, we're just not going to do the deal because the ability to grow your margin is very challenging. If you're coming to the table with a 10% margin, right?
Right.
15, it's just not going to work. So you got to come to the table with 30 or 40% margins and hope that we can grow another 10% on top of that. Because
Right.
when you get into retail and for consumer companies and even for fintech and others, like
Yeah.
no matter what, you're going to have a strong margin. So
Yeah.
I think that's probably one of the top metrics we're looking at right now.
Yeah. I mean, when you get into retail, these margins get swallowed up very quickly. So
Yep.
you need that buffer. Now, look, your entire model is built around leveraging influencers and,
Mhm.
creator economy, but the landscape is shifting a bit where
Yeah.
traditional influencer marketing is becoming less effective. Authenticity now is increasingly important. How is
Yeah.
Space Station model evolving? Are you moving more towards organic community building? Are you doubling down on large, creator partnerships like Mr. Beast, or what's the strategy as we
Yeah.
continue to evolve?
Yeah, I mean it is definitely evolving, and in some ways it's evolving in a very positive direction. In other ways, there's a lot of volume, millions of creators. Now we're seeing a deluge of AI kind of powered content, which is incredible. Truly, like very bullish on
Yeah.
what's being done on video generation. However, it can dilute the power of an influencer. That said, and maybe even more so because of that, because of this absolute flood of AI generated content, kind of trust level connections with actual humans becomes more and more important. So, what we're
Absolutely.
seeing and what we hope that brands hear and do is instead of the quicker pay to play, let me just spend 100 grand on whatever influencers and get that top of funnel, get some click throughs, and like let's call it good. Instead, building deeper relationships with individual creators and building out multi-video, multi-month
Mhm.
campaigns that
Right.
really build like a genuine bond. I mean, we very much in our agency, which by the way, we're like a very boutique,
Mhm.
powerful agency that is very much built on genuine relationships, not just if you'll pay me 10 grand, I'll talk about any brand in the world. And I think that's always been the case with influencer. At least that's kind of always been the premise. But now it's kind of like that is the marching orders going forward. But however, that
Right.
said, creators, especially at the highest ends, are just leveling up. I mean, they're truly reaching like A-list celebrity status, right? Of course, we get to
Right.
interact with the top, Mr. Beast, Dude Perfect, Mark Rober, MKBHD. Obviously, you're seeing that. We saw that with the election podcasts, and the whole
Mhm.
podcast movement has been insanely powerful in moving people, in moving
Right.
consumers. I think that we're still in the early innings of that. Truly, I think this concept of independent media through
Yeah.
podcast, YouTube,
Right.
videos is just
It's
getting started. Therefore, the creator economy side of it, the connecting consumer brands of any kind, fintech, health tech, CPG, to
right.
this creator economy is only going to grow and become more of a powerful channel, especially as we see the CAC, the cost customer acquisition cost of
Mhm.
Meta, Facebook, Instagram, and YouTube ads just
Yeah.
keeps going up, and it will. Influencer done right can be a powerful tool.
Yeah, that seems to be the case. I mean, it's probably not going anywhere as long as
Yeah.
and that's really sound advice. Do it properly. Don't
Yeah.
just go rushing into
Yeah.
building these artificial relationships just because you've paid. Make sure you build that true connection with your influencers.
Sure.
Now, what's the vision? I mean, I know you are raising the 40 million,
Mhm.
looking 3 to 5 years out, what does success look like for you? Are you looking to be, like one of those dominant VCs in the mountain west? Where are you? What's three to
Yeah.
five years looking like for you?
We really are working to build a world-class consumer fund and
Right.
consumer VC,
Mhm.
but we're not trying to build some 200-person massive kind of venture group that is just lives on management fees and trying to just continue to increase our AUM. Fund one is 40, fund two is 80, fund three is 150. And that may be the case for us to some degree, but we're very much convicted on investing in early stage consumer. And we just want to
Right.
be the best in the country and the best in the world at doing that. That doesn't mean that you have to have the largest fund. It means that, in fact, the larger you get, the more upstream you have to go to deploy that capital. You have to
Right.
get into growth. We are
Mhm.
early stage, and therefore, if we do have continued interest and great deals, we'll just raise
Yeah.
our next fund earlier. I see us finishing fund one here in the next couple of months. The
Mhm.
fundraising has gone incredibly well, which we're very grateful for. And being able to, get into fund two, fund three, fund four over the next decades, really, and
Right.
and really continue to build out this, creator focused, kind of new age venture group over the coming really decades is our goal.
Right. Right. No, that's a very good place to end it. Tim, thank you very much. That was really, really insightful. I mean, we've really explored quite a lot of topics on your, how you look at those investments,
Yeah.
your journey from, back the times of, the
Early
crowd.
ugly startup phase, which is good stuff. Yeah, I honor founders so much for what they do. It's such a blast to sit in the seat, talk
Yeah.
to the most incredible founders, just people building the future. I feel like I'm in a time machine every day, like just
Right.
going 5 years into the future. It's an honor to be able to do this, and it's just been a blast to talk to you and your audience. And yeah, anyone that would like to kind of learn more, connect. Just it's easy to connect with us, tim@spacestation.com, and we'll go from there.
Yeah, and I was going to ask that
Yeah.
actually, whether there's a way our audience can connect with you, whether there's anything else you want them to take away from today. So it's really connecting with you
Yep. Yep.
on
Connect
your
on and engage on LinkedIn is
LinkedIn.
probably the best place. We also active on Instagram. And then of course you can just connect with us directly. And those, founders that are building in the consumer space, those interested in looking at this from a venture perspective. Yeah,
Right.
love to talk to everybody.
Yeah, I'm sure people listening to this, and especially when they hear about those early DMs on LinkedIn, they will be connecting with you, hoping that they get that
That's
DM.
right. Yeah,
Yeah,
maybe I shouldn't have said that, but honestly, like we really try and want to connect
right,
with the group, with the community. We'll do our best. It is a
right.
busy time, but everyone's busy, so we'll
Yeah.
connect for sure.
Yeah. Now, thank you all for tuning in. And if you found this episode as insightful as we did, please hit the subscribe button, share it with anyone in the consumer brand ecosystem, venture capital community, or creator community who's navigating, the growth challenges and seeking strategic capital. You can also find more episodes and resources on our website, YouTube, Spotify, and LinkedIn. And Tim, thanks again for sharing those insights. Really, really good to have you on the show today. And hopefully we will be able to bring you back at some point. But for now, thank you very much.
Absolutely, my pleasure. Thank you.
And for everyone else, thank you. We'll be back again next week. And until then, keep building and keep pushing. Thank you all.